So with existing home sales in the United States on track this year, 2025, to be their slowest in over 25 years. I'm going to share a story out of the Financial Times from today. If we take it at face value, if it is accurate, what it's saying is the next several years are not going to be any better. This is despite, or let's say in the face of everybody saying now, well, the Fed's going to be lowering rates. That's going to bring the mortgage rates down, and it's going to unfreeze this disastrous housing market in this country. I will ask you to quickly go and look. Since the Fed has made its first rate cut last week, I read somewhere the 30-year mortgage is actually higher, okay? Because bond yields have been creeping up. So the opposite right now is happening. But that aside, Financial Times today, very, very, very compelling article. Before I jump into it, as I always humbly ask, please hit the subscribe button so we can keep growing the community. I appreciate it. So the real estate market, it says, has been stuck in an extended period of low inventory. Simply not enough properties being put on the market, making sales scarce and keeping home prices high and unaffordable for many. The root of the problem is a shift in ownership patterns. And it says more than 54% of homes in the U.S. are owned by seniors, right? Senior citizens. That's up from 44% in 2008. Listen to this. It says 79% of seniors own homes, and 76% of those homeowners own their homes free and clear without any mortgage. Okay? Think about that. 79% of seniors own homes, and more than 3/4 of those, according to this story, own their house outright. According to property brokerage platform Redfin, 78% of seniors want to remain in their current home rather than downsize. It says there's little doubt that carrying costs of owning a home have increased significantly over the past 5 years, even for those without a mortgage. Homeowners insurance has increased, it says, an average of 70% during that period, and there's been persistent inflation, as we know, of almost everything else. But there is an enormous cushion of equity built up in homes over the past decade, which it says has insulated homeowners from the escalating costs of maintaining a home. But they're saying it's offset that detriment with $36 trillion of equity built up in homes as of the second quarter 2025. This, it says, has made it easier for seniors to hold on to their homes by tapping into some of this equity, the built up equity, and growth in such funding will be a major theme, it says, for the U.S. economy in the next 3 to 4 years. And the title of the article is Home Equity Loans Will Keep the U.S. Housing Market Tight, which means frozen. According to the New York Fed, since last summer, home equity lines of credit, HELOCs, have consistently grown faster than any other loan category, eclipsing the growth of credit card debt. As of the second quarter, seniors held 41% of so-called revolving home equity credit outstanding. It says home equity debt is the cheapest form of consumer debt next to mortgage debt. According to the latest data from bankrate.com, the interest rate on an average home equity loan or line of credit is 8.28%. That's far lower, it says, than the average rate for a personal loan of 12.39%, or the average rate on a credit card of 20.12%. At its peak, it says the home equity industry was $71 billion, and that's going back to 2009, when home values totaled $18 trillion. Now we know with the financial collapse in 2009 and thereafter in the housing market, a lot of that equity was wiped off the books. But again, people that own their homes free and clear could technically suffer a 40 or 50 or 60 or 70% drawdown in equity, although it would be unpleasant. They're not going to lose their home. It's not going to necessarily affect their lifestyle per se, all right? It says today what we have, well, hold on, the average loan to value was 51%. That's in 2009. It says today it is worth $411 billion, that being the home equity industry, right? And home values at 47 trillion. Think about that. Home values now 47 trillion versus 18 trillion in 2009, and 411 billion in home equity products versus 71 billion in 2009. And the average loan to value is 24%. So again, if we take this article at face value, these people that own their homes outright, or have some kind of own their homes outright and then tack on some kind of a line of credit, their loan to value ratio is still much lower. It's less than half of what it was in 2009. So obviously you probably hear about the closed-end mortgages being offered. You certainly hear about cash out, refinances being offered, and all of these things, provide, let's say, this category of homeowners in this country, okay, the ability to tap into their home equity, and what that's going to do according to this article. I'd love to get your thoughts and comments. It's going to keep, according to what this story is saying, it's going to keep a lid on housing inventory, okay, because these older folks are going to simply sit on the house. If they want to pull some money out to help offset the increased cost of just owning the home, right, maintenance, taxes, insurance, etc., they're going to pull, a line of credit out at, 7 or 8%, which should be coming down presumably, and that's how they will simply do it. They will not downsize because they're not feeling the crunch that maybe a middle-aged family or a working-age family is feeling, because they leveraged in, at the height of the market. They've got, a much higher loan to value ratio, right, or loan to equity ratio than these people that own their own homes have. And so they're in a whole different category. While these seniors are going to sit back and say, we don't need to do anything. Okay, why would we need to sell? And think about it. I was talking to a friend of mine this morning, attorney friend of mine, Jim, and Jim was his brother is a realtor, and his brother and him were having a conversation about the local housing, going on in the local housing market here. And brother was saying that, look, a lot of these senior citizens, regardless of whether they are borrowing from their home equity or not, they simply, if they own their homes outright or majority outright, they will simply just leave the properties to their children. Now, when that happens, okay, you will see a dynamics change from my perspective, right? Because the kids are going to come in, maybe they don't live in the area, maybe they have different desires, different needs, and they're going to turn around and probably put those homes on the market and sell them. But for now, it says the housing market will continue to be very different from before, and there will be no quick fixes. Hence the reason for the thumbnail title today. Even as 30-year mortgage rates decline, don't expect existing home sales to pick up materially. Seniors control the proverbial chessboard. And with so many options, it says they aren't moving anytime soon. Again, it's a take or a perspective that I had not considered. I didn't know those statistics relative to ownership percentages of seniors. How many of them actually own their homes outright? Again, taking it at face value, I'd like to get your thoughts and comments. Do you agree with the premise? Okay, because if it's even half true, the housing market in this country, regardless of where rates are at, or in the next 12 months, 24 months, 36 months, people that do not need to sell. They're not distressed sellers, especially these folks in their older years that have paid off their mortgages may say, I'm sitting out this one, right? You guys figure out the you know what show, and we're gonna watch, get our popcorn and watch it unfold. So I appreciate again you guys watching the shows. If you enjoy the content, leave me a like. Please subscribe to the channel if you're not subscribed. Leave your thoughts and comments. With that being said, just briefly, markets again, S&P, another all-time high. Gold, all-time high, $60 an ounce up. Silver blew through $44 an ounce. So, we have, so far, we have everything going up, okay? As we discussed last week after the Fed rate cut, markets were unsure. We're starting to see it all kind of settle out. We're not seeing right now cryptocurrencies follow. Bitcoin's down $2,000, $3,000. Ethereum was pulling back. XRP fell back below $3. So that's going to be an interesting one to see, when cryptocurrencies are going to, get with the program. Appreciate you guys. Talk to you soon. Bye.